Hi everyone.
Welcome to Market Outlook, Trends, Risk Events, and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. I just let you have a quick look at the disclaimer. I'll just run through what we hope to get through in the next 30 to 40 minutes or so. We'll follow the normal format. So we'll just check out how markets are trading currently. We'll look at a couple of themes. So we'll look at the Japanese election, actually, some thoughts around that, and how it's influencing dollar yen and the Nikkei, obviously. We'll then just look at the big tech earnings from last week. So Alphabet, Google, and Amazon. And we'll look at some of those charts as well. Then we'll look at the S&P 500, so some US stocks, and again, thoughts around that. So that's very sharp rotation that we're seeing, um, that we saw last week, sorry. And apologies for that. And yeah, big rotation that we saw last week. So we've got a couple of charts around that. Pretty good charts to just show you what's been happening and what we've been talking about, really, and writing about. So yeah, just a bit on stocks there. And then we'll look at last week's main events. Three central banks. So we had the Bank of England, the RBA, and the ECB. So we'll look at the currency pairs around that as well, or those as well. So Aussie dollar, Euro dollar, and of course cable. And then we'll get into this week's main events and some big top tier data points out of the US. Really, obviously, this non-farm payrolls that was slightly delayed because of the partial US government shutdown. We've got the delayed couple of the days delay actually US inflation data as well. And then we've got UK data, just GDP data, but we'll touch upon the political situation, yeah, in the UK as well, which could impact sterling going forward potentially. So, yeah, various things to look at as usual. I should say, if you do have any questions, please do ask them along the way, and we'll be more than happy to answer those if we can. Anything we're looking at, of course, and anything of course, you're looking at as well. We'll try and answer anything, yeah, across markets, really. Okay, there's what we hope to cover in the next 30 minutes or so. Stocks currently sort of mixed, really. Asian stocks began the week higher after last Friday's rally on Wall Street. That saw the Dow Jones top 50,000 for the first time. We'll check out that chart. Really nice break after bullish consolidation, really, for the Dow anyway. Not for the Nasdaq, of course, and the S&P 500. Um, as I mentioned, the Nikkei 225 in Japan that hit a record high after PM Takaichi's landslide election victory and supermajority. We'll get to that shortly. Other news, interestingly, China reportedly urging their banks to curb US Treasury exposure amid market risk. Bloomberg reporting that, citing sources not necessarily to do with sort of geopolitics, but just market risk, is what we've been reading. But still, well, interesting. The guidance does not apply to China's state holdings of US Treasuries. Um, and yeah, just for your guide, really, China and Hong Kong hold together around $938 billion worth of US Treasuries. That's of last November. So comments sort of like these, stories like these, come at a slightly vulnerable time, of course, for the dollar, where that sort of de-dollarization, dollar diversification theme is obviously rife. So just watch out for that, whether it's anything more than just that big headline and about market risk, or whether it's something bigger. We shall see. European equities, pretty mixed, as I say. Eurostox 50 giving up early gains, really, after the market, cash market, that closed 1.2% higher on Friday. US equity futures, they are slightly red, actually, led by the NASDAQ. Um, right, let's get on to Japan then. And firstly, just pull up dollar yen chart. which is here. So yes, we had PM Takeichi's bold gamble, really. She was only sort of 50-50, I think, only a few weeks ago in betting markets that she would secure a victory. And then she's just secured, yeah, a landslide victory in the snap elections that we got yesterday. The largest two-thirds majority in the lower house since the party was created in 1955, actually. Compromises don't now have to be made with coalition partners. That was what we originally thought with those betting markets as well. And the LDP is now really immune to spending pressure from the opposition, given its strong mandate. Really interesting that, really important that as well. And then interesting, actually, the consensus in FX markets had been that a large LDP win would trigger a big sell-off in JGBs and the yen, essentially because an unchecked LDP would push ahead with unfunded fiscal giveaways, really, and potentially as well lean on the Bank of Japan not to tighten. But so far, we haven't had that really. The LDP seems to have contained the fallout in the Japanese government bond market, the JGB market, basically by arguing that the temporary tax cut on food would not require the issuance of fresh debt. For markets, then, instead of sort of being a slightly sort of sell Japan story on the sort of government bond side and the yen side as well, really, it's kind of evolving into a sort of buy Japan story, really, on a government with a clean mandate to deliver growth. So we're not seeing the yen lower, although of course, and we'll just talk about this when we get to this chart. There are intervention fears, of course, as well. Um, but yes, maybe too early to conclude that sort of idea about the non-selling Japan story on the government bond side, at least. Um, but certainly, we're seeing buy Japan side on the Nikkei side, on the stock market side. And interesting as well, the market is pricing a higher BOJ policy rate on this. And given that the market will be bracing for intervention, as I've said, then that's kind of what we're seeing at the moment. Longer term, yeah, we'll be watching out for that sort of idea around those two themes. As I say, then the yen stable and actually gaining. JGBs, so the government bonds, stable as well. They were initially moving higher, but not so much now, and that's I'm just watching the ultra long JGB yield, so that's the one most sensitive to the fiscal sort of concerns, really. So that's the 30-year yield, just for anybody looking at those kind of things. Yeah, they quickly erased the few basis points that they gained at the open, the long end, basically, in the Japanese government bond market. Dollar yen, though, you can see interesting. Yeah, we all thought we'd probably get up to this key sort of resistance level at sort of 159, just below 159, really, that we hit. In mid Jan, we got, where did we get to? We got to 159.45 actually, but that zone really, really strong resistance. And we didn't get anywhere near it really. We didn't get above 158. And we're just on the blue line, which is the 50-day moving average of 156.30. Whether that's initial support or not, you can just see that obviously huge move lower from as we've talked about, really 159 down to sort of 152 area in a few days after that rate check speculation, really, that the New York Fed was helping the Bank of Japan in intervention. We haven't had official confirmation of that. And Scott Bessent, if you remember, the Treasury Secretary, did well, he didn't confirm that essentially, but anyway, then we got mixed messaging. We talked about this from President Trump about the strong dollar, and then Bessent as well. But in any yeah, anyway, we saw yen weakness coming into the election. But that consensus hasn't really happened, really, with the selling of the yen, as I said. So 156.30 initial support, and then you've probably got a minor fib level at 154.31, and then you've got the 100-day at 154.33, and then certainly you've got these lows from the end of Jan, just above 152 there. Otherwise, yeah, 159 area low 159, high 158, very strong resistance to any move higher, it would seem. Okay, that's the yen. Let's get to stocks now, actually, and we'll look at Alphabet first. Bear with me, I'll just pull up the chart, which is here, of course. We talked about it in our daily commentary as well, actually. Um, just here, here's the chart. So, yeah, their results came out. Alphabet's came out on last Wednesday after the US close. And the stock moved down by around 4%, I think, in the end. Um, just on those details in the numbers, then revenue that those beat 97 billion versus 95.1. That's up plus 19% versus last year. And actually, then total revenue, search revenue, and cloud revenue all increased and beat expectations. EPS $2.82, sorry, $2.82. That smashed estimates of $2.65, and last year's was $2.15 only. There was a 17% jump in search revenue and a pretty staggering 48% increase in cloud sales. But and the big buts you probably know is AI spending around 175 to 185 billion dollars worth this year versus 93 billion dollars estimated last time. That kind of means if you work it out, Google is going to spend nearly $500 million on AI every single day this year. Quite astounding. Doubling of capex really is seen actually as further boosting cloud's growth. That's what the company is saying, of course. And if you think about Q4 Gemini app monthly active users, they say now over 750 million versus 650 million in the last quarter. Obviously, key then is cloud growth in the next 2 years, really. Some investors, of course, the market's been spooked by this huge ramp in capex, in capital expenditure, in investments, basically. Though really bulls say it does signal Google is confident about its revenue prospects, driven by increasing those monthly active users for Gemini. And of course, we have had that recent pact with Apple's Siri. Expectations, of course, were sky high going into this report. The stock you can see here was at record highs. So it was very, very tough to beat any of these expectations. The stock actually has surged over 60% in the past 12 months. And of course, that's pushed the valuation, the market valuation, beyond $4 trillion and beyond actually Microsoft to the third biggest company in the world. So yeah, tough to beat, really. Big capex plans. A sort of slight red flag for markets at the moment, of course, with that theme very much evident. And of course, then we've had a tough sort of broader environment for mega cap tech stocks. You can see here then the chart, a couple of down days, strong down days. But interestingly, on Friday, we got some dip buyers coming in, got down to a low of 306.92. The blue line's the 50-day moving average, acted as pretty good support. That is at 322.41. And then you've got that previous high we've got in there, is that dotted line from November at 328.67. Yeah, so interesting. Last week's low will be key 306.92, and then obviously record high beyond that 328.67 is at 350.15. Otherwise, let's move to Amazon as well. Then, obviously, that grabbed a lot of headlines. That was they reported the day after, on Thursday, after the US close. Just bear with me 1 second. Where's the chart? There, apologies. So different kind of chart, of course. Amazon was well on Friday, before the open, was scheduled to close down 10%. It did close down 9.99, I think, in the end. All about AI spending, of course, $200 billion versus a 1 at 48 estimate. Um, if you think about it again, every day that's $548 million, I think, spend on AI. Really aggressively investing in data centers and other infrastructure, really to meet this surge in AI demand that they're seeing and forecasting will see. Just on the numbers, revenues, 237 billion, that beat the 211 estimate. AWS, which is obviously its cloud business, that's the profit engine, fastest growth in more than 3 years. Just on the the e-commerce retail business revenues, they were up 10% to 83 billion. Ads as well increased and beat expectations. But EPS did miss slightly, $1.95 versus $1.97 estimate. But all in, Amazon crossed a historic $700 billion annual revenue milestone. But then the key, as I've hinting really, is these investments, which are growing, of course, faster than returns, really. And much like we saw with Microsoft, just to reiterate again, investors worried about the timing and returns on these spending plans. Just looking at big tech earnings that we've seen, I mentioned Alphabet then, 175 to 185 $1 billion expected to spend in 2026. Meta, that said, its investments could nearly double, if you remember, from their 2025 forecast to around sort of 115 to 135 billion. So still less than Amazon's 200 billion, basically. And I think interesting, it could mean Amazon posts negative free cash flow. Not like most of the other hyperscalers seen being able to fund their investments. Amazon may not be able to, and I think that's a big reason for the stock being down so much. That said, the CEO, of course, did repeat he sees strong long-term returns from opportunities like AI, chips, robotics, and even low Earth orbit satellites. So you saw the stock here did close down as well, another 5%. So 5.5% on Friday and 9.9, I think, on no, sorry, what am I saying? Yeah, sorry. Friday was the day after results. We are scheduled to open down 10%. But we then, you could see dip buyers came in and we closed down 5.6%. There we go. Um, where do we get to? So the low was 200, nice round number, which sort of tallies with these lows from May of last year. Interesting that. So found some support there. We've probably got this next level around 212, which you can see was the low in October last year. And also then August last year, 211, 212, probably initial resistance. But we are below the black line, which is the 200-day moving average. That's at 223. And then we get back into this range really that you can see with sort of top side capped at sort of 250. So we are oversold, you can see, and that's why dip buyers really looked at it along with that support from that May low. Really will be interesting going forward what happens with this stock, obviously after the big open down, but then dip buyers appearing. Otherwise, broader indices. If we just pull up the S&P 500, gained on Friday, of course. Stronger footing, really sharp rebound in the US. Ultimately, actually pushed equities, global equities, higher for the week. That came despite the continued weakness in consumer discretionary, sorry, led by Amazon, and lingering pressure, as I've mentioned, on several of the other mega cap names. The tone within tech, though, this is key really for markets. What we're looking at, really, the tone within tech shifted meaningfully, really, with semiconductors and broad hardware, really, still finding relative strength. But there was a rotation, which was very, very severe. So there was rotation out of US software stocks, that is, they fell roughly 7%, but contrast that with tech hardware, which rose 7% for the month. That bet is that essentially AI will kind of mess up the business models of the existing software leaders, while requiring everyone else to invest more in computing capacity. So, really interesting rotation that we saw. Small caps also performed strongly versus large caps. And we saw the Russell 2000, that's the small cap index, up 3.6% on Friday alone, really. And that does underline the breadth of the move away from crowded growth exposures. And we saw that, of course, as well. Some of these leveraged, over leveraged, crowded trades are mentioned in our weekly commentary, actually. Bitcoin obviously getting hit massively, silver as well. Some of these crowded trades that have done well and or not so well, and just deleveraging has taken place, in some of the more risky assets. Um, if I just show you as well, so this is the S&P. Actually, I was going to show you a couple of charts that I wanted to, I'll get to shortly. S&P though found 100-day support at the 100-day moving average. That's the grey line, just below 6,800. 50-day moving average, that's at 68.85, and then you've got, well, the record high is actually intraday record high just above 7,000. I think that's correct. Depends what provider you use, but around 7,000. Of course, big resistance at the moment, but a very nice 2% gain on Friday. So we're looking at that 7,000 level again. Nasdaq underperforming, of course, below the 100-day moving average at 25,206. 50-day at 25,452, and then that record high at 26,182. Last week's lows at 24,455, and you've got the 200-day moving average, that black line just below, but above that sort of swing low from November around 24,000, with the 200-day moving average just below that, 23,740. The Dow is interesting, of course. I said classic break to the upside after sort of consolidation. You can see there. Beat 50,000 as well. So that's really interesting. And futures just sort of pretty flat, really marginally lower to open, but still holding above 50,000. 50-day moving average, 48,616, sort of tallies with these recent lows. So pretty bullish in the Dow, you would think. Let me just grab these charts that I wanted to show you. And just showing you really this rotation theme out of software into hardware. You can just see black line is hardware, semiconductors, basically. No, sorry, apologies. Blue line is the semiconductors, which is what I was talking about, and computing capacity essentially doing well. And then obviously software, the black line, really not doing well, as essentially as Claude and Anthropic launched more LLMs basically, and AI bots, which were agentic and basically seen as usurping software. So yeah, really interesting. Whether this can turn around at all or not, this trade, we shall see. But some of these stocks, I should say, are very cheap. Some of the software stocks, very cheap. For example, Salesforce, just for your guide, now trading at 14 times earnings. Its average over the last 10 years is 46 times earnings. So that's interesting for us. Just as your guide, for your guide as well, software, financial services stocks, and asset managers all tied into this sort of software bucket, if you like. They lost $611 billion between last week, but they are now trading on a record low valuation. So interesting whether some dip buying will be seen, or more dip buying. Okay. Did have another chart. That's the normal chart that I show you, just this mag 7 lag 7 sort of idea versus the S&P. We've shown you that over the last few weeks, and that's what's been happening. And then I meant to show you this chart, sorry, just on the yen and Takaichi. You can just see how well the topics is actually chosen here, which is a sort of less tech heavy index than the Nikkei, and more broader really. So kind of better gauge on it. Although I know everybody looks at the Nikkei. Yeah, you can just see how that's outperformed the FTSE All World Index there. Okay, moving on. Let's quickly get to last week's main event and all these three trio of um, central bank meetings. All Bank of England and the ECB held steady. Bank of England first of all, they held rates at 3.75%. Uh, but the vote was very split. 5-4 was the vote. We thought 7-2 or possibly 6-3. 6-3. We then highlighted actually if Ramsden did vote for it, then that would be slightly dovish. 5-4, very dovish, really. Forward guidance that points to a slower pace of easing in 2026 than 2025, but future decisions were characterized as a closer call. And then, according to the minutes, well, there are presently three camps in the MPC. So most hawkish, certainly they advocated for to keep rates on hold, concerned inflation may hold above target. The middle camp, which contained Governor Bailey and Catherine Mann, now actually noted that there is room for additional easing, but wanted further evidence that weaker activity will feed through to inflation. While the four doves that voted for a cut were already confident that inflation will normalise. We also had updated Bank of England forecasts as well. They certainly make the case for additionally easing in 2025. Most notably, the inflation profile has been revised down significantly, foreseeing a return to 2% by Q3 of this year, actually, and a pace at year end, half a percentage point lower than expected 3 months ago. So big adjustments there. GDP, that's forecast to be 0.3% lower in Q4 of this year at 1.1%. And the unemployment rate is seen 0.3 percentage points higher at 5.3% now. So yeah, dovish Bank of England and an MPC really. Bets on a March cut have risen now, and then we should get potentially a final cut in Q2. Um, yeah, interesting vote split really, and Governor Bailey will be key then going forward as to whether that 5-4 tips then into a rate cut as soon as March. You just got inflation there, and there are, I know, a number of economists thinking this will lower very quickly, very soon, before then sort of down to 2% before then rising a touch higher through the middle of the year. If we look at cable, bear with me 1 second. Actually, we'll look at cable. We'll look at cable when I get to UK GDP, actually, because I want to just highlight what's been happening in the political situation. So that was the Bank of England. We also had the ECB meeting, pretty much as expected, to be honest. Held rate steady at 2%. No new forecasts were released, actually. Central bank's forward guidance largely unchanged. Governing Council set to follow a data-dependent meeting approach, exactly what we said. In the press conference, Lagarde did highlight external risks stemming from a volatile global policy environment and actually weaker sentiment in financial markets. On inflation, she stated that underlying inflationary pressures remain consistent with the 2% target, so all good there. But she also acknowledged that euro appreciation could push inflation below the desired level. Interesting that we wonder whether how much she would comment on the euro really. But the stable outlook for inflation did allow President Lagarde to reiterate that the ECB is in a good place, signaling that she and likely most governing council members actually currently see no reason to alter the existing policy stance for the foreseeable future. Probably, at the moment, policy likely to be unchanged even through the whole of this year, 2026, though certainly we're mindful of the potential disinflationary impact of euro appreciation. Yeah, which potentially we need to monitor, sort of 120 line in the sand. And we've talked about that previously with some doves coming out, of course, already when we did pop up above that recently. We did get Eurozone inflation as well. That declined as expected, actually, to what 1.7%, a headline from 2%. And the main reason, really, sharper energy deflation. Sharper energy deflation, certainly, and core inflation declined more than expected, falling from 2.2 down from 2.3, actually. That really due to services, which rose only 0.15%. Okay, otherwise, actually, we'll look at euro dollar now just quickly. Euro dollar chart this is, so bear with me 1 second. Here we are. Yeah, a little bit of a bid to the euro dollar. Investors favouring foreign assets really on the Japanese election, on the back of that really, as well as just some labour market data last week was weaker, obviously in the US. We'll touch upon that shortly. So a little bit of a bid after some consolidation around 118. You've got that previous high from September at 119.18. And then you've got that high cycle high at 120.82 as well to look out for if we beat that sort of 119.18 level. Downside, you've got the 50-day moving average 117.34, and then the 200-day, which taps this sort of low, mid-January low around 116.19. Also, we had the RBA, of course, which was interesting. Of course, they were, well, the first rate hike from a central bank in an advanced economy actually this year. Hike rates as expected by 25 basis points to 3.85%. Motivation was pretty straightforward, really. I think they said a wide range of data over recent months confirmed inflationary pressures picked up materially in the second half of last year. While some of that reflected temporary factors, private demand is growing more quickly than expected, and capacity pressures are greater than previously assessed, while the labour market conditions still are a little tight. If you remember, headline inflation that increased to 3.6% in Q4 of last year, while underlying gauges they accelerated to 3.4%, so well above that 2 to 3% target band. And also higher than the RBA expected. Let's not forget that. Strong upward revisions actually do see CPI as well not returning to the 2 to 3% target band till mid 2027. And growth, well, GDP will be at around potential 2.1% and probably quickened in the final quarter thanks to strong private demand. Aussie reacted well. It jumped actually above 70 after the meeting, which was on Tuesday of last week. So, yeah, Tuesday we had a big jump. And through that long-term high from October, September of last year. That was at 69.42. And we're now consolidating above that. Very strong, very positive, really. After we broke above 69.42. That's decent support, you would think. And it's sort of similar to this here in our eyes, really, where you get consolidation near the highs and then a big, sharp break higher in line with a dominant trend. So potentially, the only thing is this spike high, which is at 70.93. But potentially, we're tracking sideways, should see some range expansion, and typically that's in line with the dominant trend. We've eased back on those overbought positions you can see there. But potentially, if we do get up to here, then we will be overbought again. So just watch out for that. If we just pull this back, where's the next level? Probably it is the January 2023 high at 71.57 there, you can see. So interesting levels for the Aussie. But yeah, was really expected after this range trading, then we were going to see a big breakout at some point, and we've talked about that previously. Just on the RBA, yeah, markets now see 22 basis points around that level priced in for the May meeting. So it's another hike pretty much, and around 37 basis points priced in by year end. Governor Bullock, she left all options open for future moves. Um, Although she did say she thinks rates might be around neutral during a press conference, but that was, well, aimed at toning down the sort of initial hawkish reaction, really, to the statement. So that's the RBA. Interesting meeting for sure. And the Aussie responding. Let's now go to this week's main events very quickly, which are, of course, US data-based non-farm payrolls and US CPI. Just want to mention, well, let's get to, yeah, non-farm payrolls. Here's the graphic, which has all the main numbers on. So consensus sees around 70,000. I think it may have dipped slightly, 65, 70,000. That will change through this week, possibly, versus 50,000 last time around. That's the headline. Unemployment expected to be steady at 4.4%, and wage growth also unchanged at 0.3%. Recent jobs data that has, well, it's interesting, really, sort of shown some stability in the face of other policy challenges and hiring. Well, hiring may be temporarily boosted by fewer seasonal layoffs. But then, well, in the week that corresponds with the BLS survey window for collecting data, weekly jobless claims, they remained low, around 210,000 after revisions. That compares to 224 heading into the December data. Um, we did get a bunch of labor market data last week, though. So ADP, just for your guide, that showed employment increased by only 22,000. So that was below the consensus 48,000. The Challenger jobs report that showed actually more job cuts than expected in January. And then the JOLTS job openings data that came in at 6.5 million, well below the consensus 7.2 million. That means the US ratio of job openings to unemployed fell to, well, under one now, so 0.87 in December. That is a cooling in the labour market at the bottom line, and is actually also a good predictor for softening wage growth as well. But certainly a concern for private consumption potentially as well. That outlook and all else equal really supports potentially a softer position by the Fed. Um, there are the flip side to that, sorry, is ISM manufacturing. That surprised certainly, while the services was as expected. And it does also contrast with Fed Chair Powell's categorization, really, of the labor market. And I'm just checking that quote really. Yeah, the Fed last week, week before, sorry, they tweaked their risk characterization of the labor market. If you remember, replacing job gains have slowed this year, and the unemployment rate has edged up through September to job gains have remained low, and the unemployment rate has shown some signs of stabilization. I know a lot of economists do disagree with that, and I've just sort of highlighted some of that recent data, which sort of contrasts with that feeling. Um, and I should say as well, we always highlight the fact that a lot of the jobs, virtually 90% of the jobs over the last 8 months at least, have been in sectors which really aren't associated with strong economic growth. Healthcare, government, and hospitality, the sort of three main sectors really, which contrast with sort of construction, tech, manufacturing, which would be associated with a much healthier economy. So we'll be looking at that detail, some of the jobs and where they are created, I guess. Also, I should point out we do get the annual benchmark revisions, and they're likely to show last year's jobs growth was weaker. And that kind of then plays into the sort of gradual cooling impact that we're seeing in the labour market. Um, uh, yeah, over the last few months. That revisions data, if you remember, Chair Powell said it was around 60,000 per month, an underestimation. Um, and I know that the original estimate was around 911,000 across the year, which is around 78,000, I think, um, per month. But Chair Powell said that would be a touch low at 60,000, but whatever, it will be showing that jobs growth is potentially lower for the year that we have seen. So that's just something to watch out for, along with the normal report. Some economists, just for your guide as well, should point out they think there could be some impact of some of the extreme weather conditions we've seen. Construction payrolls are particularly sensitive to that, though I know other economists think that the storm occurred outside the period, so it shouldn't impact this employment report. You can just see the odds then have jumped actually recently. So it's now a coin cost, as I said, 50-50 bet on whether we get a 25 basis point cut in April. And then there are around two 25 basis point cuts priced in for then the whole of this year. That is against that central production projection, sorry, that we saw by the Fed of just one move this year. Here's just a guide. It would be a 4 month high if we do get that 70,000 or so print. You can see there in the headline. So that is non-farm payrolls, really, which is due out, sorry, on Wednesday. Then we do get US CPI data on Friday. That was originally scheduled for the Wednesday, actually, but being pushed back to Friday. Pretty much in line with what we've seen, 0.3% month on month for core and headline, 2.5% month on month for year on year. Some private sector measures of inflation have slowed sharply of late, but potentially there will still be stickiness in this report, really, largely due to these delayed tariff impacts, which we've sort of not seen just yet. Import prices, just for your guide, they continue to rise. And tariff tax revenue is being paid by US importing companies. There are suggestions that kind of efficiency savings are allowing companies to offset the cost increases from tariffs. But the risk that, well, there is potentially some more feed through to come for consumers. We're still waiting, as I say, for this sort of tariff pass through, and we haven't really had it as yet. Otherwise, lower energy costs and slowing housing rents should continue to partially offset any of that tariff pass through, if you like. Here's just the core and the headline you can see, and then the 2% sort of target, inflation target by the Fed. I always say this, but we need, just for your guide, a sort of core month on month reading of 0.17% over a number of months to get back to that 2% target, just for your guide. Okay, let's look at the dollar index chart just quickly. Oh, one sec. Which is here. So we're just getting a little bit of sell-off, as I said. Japanese election, foreign assets in demand, and that weak labour market data last week, potentially setting us up for, obviously, non-farms on Wednesday. Yeah, dollar index chart, always say this. Obviously, the euro has a big weighting in this index of six currencies in total, a euro weighting around 56, 57%. So always remember that if you can. Yeah, long-term low, 96.21 still in play, really, even though we got a bit below it, but that didn't last long. We got down to 95.55, you can see there. And obviously, I've shown you this before, but there's long-term upward trend line from the 2011 lows and the 2021 lows still valid for us. And you can see that here. We're trading around it, but of course, it's very long term. So give it a bit of room, but around 96.21, big support. And then you've got the 200-day moving average above that, 98.57, the 50-day just below that, 98.31. Okay, UK data, we do get the GDP data, as I said, might not be that important really because MPC focused on other things. Backward looking data, still expected to be positive at least 0.1% Q on Q, 1.3% year on year. I think the restart of there was car production at one of the big car producers, Jaguar Land Rover, that boosted Q4 really, and sort of solid growth momentum should carry over into 2026 this year. If I just show you the cable chart, which is, I think, interesting because we have political sort of factors now as well to consider when you're trading sterling. Pressure is building basically on UK PM Starmer. One of his close allies, former chief of staff, basically was forced to resign yesterday for his role in the appointment of Mandelson, Peter Mandelson, as UK ambassador to the US last year. This due to the Epstein files. If you know about this, been reading about this, a really big issue for that appointment. Questions really are still lingering over Starmer's judgment, and really likely to remain as the decision to sorry. Question marks over his judgment are likely to remain. Sorry, just with this appointment of Mandelson, which will face further official scrutiny as well in the UK, with the police now investigating Mandelson. And well, the Labour Party in general, which is PM Starmer's party, of course, that faces political reckoning soon. We get a by-election in late February. That's like one of the seats in Parliament is up for an election, basically. And then we get the bigger local elections for basically local councils. They are in May. Pressure should potentially still remain on sterling and gilts. If you watch gilt yields rise, then that is potentially a political issue. If other bond markets and those yields in the US, for example, aren't rising as well, uh, uh, all to do with speculation over a change of personnel at numbers 10, which is the Prime Minister, and even number 11, the Chancellor, potentially, if we did get a leadership contest and a new leader. Obviously, the dovish twist by the Bank of England as well put sterling under a bit of pressure. Cable is obviously against the dollar, so it doesn't really show you that sterling weakness, if you like, and we're moving higher, of course. Just on cable, I guess we've got the 61.8 of this move up, which would be the 38.2. Sorry, that's at 135.40 there, dotted line. And then you've got a minor fib level 136.85, and then that's high at 138.68. If we look at euro sterling, though, better gauge really. And euro sterling's going higher, so sterling is selling off there. We sort of found support around the 200-day moving average, the black line at 86.50. Then you've got resistance at the 50-day, 87.05, and then the 100-day at 87.25. That looks like decent resistance, actually, because you can see it's capped sort of the top side over a number of occasions. But if the euro can break above that, then probably 88 and 88.50 are targets if we see politics entering sort of the UK landscape, if you like, and FX. Okay, I should wrap it up there, been nearly 50 minutes or so. Again, nearly everybody actually has stayed around. So really do appreciate that as always. Please do follow us on social media, and also, as I always say, daily commentary on the website after the US close. Some interesting data points, of course, with the non-farm payrolls data, certainly going to be volatile. And of course, then question marks still over this rotation that we have seen, a very sharp rotation out of some of the tech stocks into other tech stocks, actually, but still with the Dow and value stocks outperforming. So, yeah, interesting times. Take care, and we will speak to you the same time next week.